my account off 4 years of profits were gone. And I'm watching the account bounce around 30, 40, $50,000 at a tick.
Today, we will dig into the 112 strategy. My guest has traded it for years. He has seen great results, but also shocking losses. Welcome, Murray Lindhout.
Hi, John. Thanks for having me today.
You lost 3 years' profit in a couple of days last year, and yet you are up on the horse again and still trading the 112 strategy. What's the attraction?
Well, I think the attraction is trading to your lifestyle. Some people like the zero DTEs because they like to be in front of the computer. I don't. I'm a very active person outside. I like minimal time in front of the computer, and the 112 strategy fits that style for me.
Can you explain the 112 strategy in 20 seconds?
Yeah, the 112, it's a put debit spread at a 25 delta. And then you go out and sell 2 further out of the money puts so that the overall strategy is a credit. I personally aim for around $10 credit at about 90 days to expiration.
And we will dig into all the details about this. We will also tell the story about how your big loss last year. That will be later in the interview. But first, tell us a little bit about your journey into options trading and what you do for a living.
Well, John, I'm a 40-year veteran of a high school math teacher. I taught AP classes, always loved derivatives since I taught it, and went to an options strategy class only because I invested in a 401k mutual fund that was supposed to be very secure and ended up going belly up, where I lost $500,000 and had to settle out at $30,000. So I said, they're not managing my money, so I better manage my money. And that's where it all began.
Okay, so let's move to the 112 strategy and repeat how you set it up. Maybe we should bring up an example.
Yeah, so the 112 strategy, as you can see, has a put debit spread, which we kind of use to help hedge off the market as it moves down. And then it has 2 out of the money puts that finance the put spread and leaves you a small credit. So if the market moves up, you'll make a small credit return, somewhere in the neighborhood of 2 to 4%. If the market moves or just stays the same, you can make 2 to 5%. If the market goes down, you can make a lot of money. And that's the trap part. That's the high elevated green part in your visual picture there. That's the 112, a put debit spread and 2 out of the money puts.
What is the underlying you're using for this?
Well, you can use a lot of different underlyings. I use the ES, that's the futures market for the S&P 500. And you notice in the example there, that put debit spread is buying the 5,700 and selling a 5,600. That's 100 wide. And then I go way down to 4,500 and sell 2 of those. And again, the ES, the reason that I use it is basically because of the massive amount of liquidity.
Can you do this on SPX, for instance?
Some of the bigger traders do use SPX. In fact, a lot of traders use multiple different assets. And that I'll save for later in the discussion because that's what I've migrated to myself, uncorrelated assets, to give you more risk protection.
Tell us a little bit more in detail how you set up your trades, days to expiration, your mechanics for setting up a new trade.
That's a good question. When you follow some of the 112 forms and stuff, everybody kind of sets it up differently depending on their own personal lifestyle and their risk tolerance level. I originally, for the past 4 years, did pretty standard 50 wide at 25 delta. So I'd buy a 25 delta put and then sell a 50 wide delta put against it. And then I would just go out as far as I could, trying to make my trap as large as I could by still receiving somewhere around $10 of credit. Now, I've completely changed that since the crash, but I'll explain that to you later. So I think to answer your question, John, it depends on your risk tolerance, because if you're trading 45 DTE, days to expiration, or 90 DTA or 135 DTE, you can set those up in a different risk format. It just depends on your particular risk profile that you're looking for. But in general, most people go out 45 to 90 days. They'll buy a 25 delta put. They'll sell a 20, 21, 22 delta put, whatever they feel is a good hedge, you might say. And then they'll go further out and get a credit. Some people are aggressive. They'll get a $20 credit in the overall trade. I personally like the $10 credit. It gives you a nice wide profit track.
Is it correctly understood then that you make the most of the money on the too short out of the money puts, but the put debit spread there is to somehow as a hedge and to protect you against too big loss?
Well, that's what I thought originally. And I kept statistics, being a stats teacher. I kept statistics from month to month. I actually did week to week, I actually did day to day. But no, the put debit spread, as some people would call it, a delta hedge, actually profits quite often when the market is stagnant or the market just slowly drifts down. Your profit comes from that put debit spread, because the put debit spread's making money as the market moves down. And if it's a slow regressed market or stagnant market, the two out of the money puts are also decaying. So you're getting theta decay in those, or vega drop, or you're making money on the put debit spread. So I've found that about 30% of the time, my put debit spreads are helping me.
How often do you put on these trades, and how many trades do you have on at any time?
So again, that's kind of a risk tolerance level question, but in my previous 4 years, I kept my working capital at about 50% of my buying power. And when I started in 2020, I said, you know what, I'm just going to do this on the ES because it's the easiest way to manage it, just having one asset class. And so I would put on as many trades as I could I would say I did probably at least one a week, sometimes two a week. And I would just kind of stagger those trades in over time, so that as one were coming off, I would be putting on a new one. I wasn't necessarily waiting for a volatility spike to put one on, but it certainly is helpful if that happens. But, again, I was under I guess my philosophy was to stag all of my trades out throughout time. Some people like to do maybe one a month and put on more contracts. Instead of a 1-1-2, they might do a 5-5-10. I just kind of liked having them kind of dispersed over time, which in the end bit me a little bit. And we'll explain that later.
What are your exit rules? When do you take profit, and to what extent do you have a stop loss?
Don't have a stop loss in this trade, because even through my entire 4 years, I've never had a position that went past my naked puts. So I don't have a built-in stop loss. As far as I'm taking profits, it kind of market dependent. If the market moves up on me, might stay in that trade to expiration. If the market moves down, I definitely want to keep it on, because I want to be in that maximum profit zone. So again, it's just somewhat depending, I think, on your personal risk tolerance level. A lot of guys do like 90% of the credit. I generally left them on to expiration.
To what extent do you adjust trades during its duration, or manage it in other ways?
In general, John, no, because I'd be putting new positions on every week. Those would kind of like adjust to the market conditions. But I think if you were a once a week or once every 2 weeks or once every month, you would probably do more adjustments, maybe slide your put debit spread up or slide your put debit spread down. But since the big crash, I've made a couple changes, and we'll highlight that later in the video here.
There are some variations of this trade. I know you also trade a variation that is called 1-1-1. What is that?
Yeah, the 1-1-1 trade is actually what I enter now. It doesn't mean I stay in that position, but I do enter in that position. And all it does is it's a little less profit on the upper end, but it's a lot safer on the lower end. You'll notice the trap part, the part that's in green there, is smaller. This is a buy a 5,700, sell a 5,600, and now you're only down to 5,000. So you don't have as much downside movement. But in theory, John, if the market's going to go down to 5,000, you got some other issues. And one of those is vega. And it's the volatility in this trade that you got to watch and be careful in.
The difference between this and 112 is that you are only selling one out of the money put, right?
That's correct. And by selling two, you can make the trap part of this trade much wider, like all the way down to 4,500. By selling one, you got to move that all the way up to 5,000. But your risk, you would think your risk would be more because you're closer to at the money. You're actually less because you only have that one naked put that's being affected by the vega component of the Greeks.
Murray, let's look at what happens when the implied volatility goes up a lot. Now we are 25 days into our example trade. If I pull up the implied volatility, what we see now is that the loss zone is becoming much bigger, right?
Correct. This is where patience comes into play big time. Of course, every trader has to learn that rule. You and I think, both have been down that path. But yes, as volatility expands, those naked puts become extremely expensive. And as you can see, you have temporarily unrealized losses. That's the hard part of this strategy. But to be honest with you, it doesn't happen that often. I mean, this strategy can take on a pretty good 5, 6, 7% increase on the VIX, and it's not real noticeable in your count. It's just when it goes to 60, that's when you notice it.
You said that you are trading ES, the futures, with this strategy. Is that the only underlying you're trading with?
Well, John, when I started in 2020, I was trying to keep things really simple. So I said, yes, I'm just going to trade the ES futures. What I found out, which we're going to talk about shortly, is I needed to diversify my assets better. So now I trade ES, I trade gold, I trade bonds, I trade oil, and I try to keep those equally balanced with the 111 or 112 strategy. But what I really like about futures, at least here in America, we get what's called a 1256. It's section 1256 of the tax code tax break. It's a 60/40 tax supplement, which is just really nice. When you have profits, you don't have to claim all of them that way. And also, the futures trading, you're trading 23 hours a day, 6 days a week. It gives you a lot of market time. If something were to happen at night, you could make an adjustment or throw on a hedge or whatever you need to do. But I love the availability of the futures.
We have referred to your huge loss last year, and you actually posted in a Facebook group this picture that showed what had happened to your account. And this was in August last year, where we saw quite a turbulent market. Take us through what happened.
Well, John, maybe we should go back a little bit and show your viewers, I guess, why this was caused by my trading style, by looking back at maybe my yearly returns. And we'll just build up to this crescendo moment and the lesson that was learned. If you want to throw up that yearly profit chart, starting with 2020, and you notice in 2020, I started just in the ES with $50,000 account. And the dark black line, that's my cash account. And the light gray bar is the IRA account. And the red bar that you see there is the S&P 500. And you notice in 2020, the IRA and the cash accounts outperformed very well. And that was the COVID year. In 2021, again, outperformed very nicely. 2022 was the best year. That was the year, I believe, the stock market was down around 19-20%, and my account was way up, way over 100%, 106%. This is when the strategy really performs. When the market falls off or is stagnant, you get a lot of volatility, a lot of premium. And then in 2023, another banging year. It started with 50,000. I think after the first year, it was 137,000. I think after the second year, it was up to 209,000. In 2023, I think it jumped to 431,000. And then just before the big crash, I think I was just over 526,000, somewhere in there. So from 50,000 to about 500,000. So now, John, if you throw on that monthly performance, and this is the last year, 2024, you can see how from month to month, January was pretty decent, February, March, and April was great. The market was down in April, the account was way up. In May, the market bounced back. So the market actually beat the account values there. But if you average those last 2 months together, you notice the market's flat and the account's up 12%. And then you have the next couple months. And then comes August, John. If you show the next slide, this will be a weekly graph. And you'll notice this is the week before the carry trade, the August 5th carry trade. And you'll notice the account's doing well. And you'll even notice that this strategy performs great when the market goes down. It performs great when the market's stagnant. It doesn't keep up with the market, though, when we have those booming 2-3% days. It doesn't keep up with it. But overall, it's really outperforms the market. This now is the Friday. I just recorded the week of the carry trade. And that Friday, we had a huge vol spike. I think the VIX went from 14 or 15 up to 35 or something. It was just a huge jump. And that took my account way down. In fact, just, I don't know, what is it, like 16%, whatever that is. I mean, that's quite a crush. That was on that Friday. And my buying power went up. I was thinking it was like 60%, 50 to 60%. I thought, hey, what a great opportunity, John. The volatility is high. The VIX hasn't been at 35 in forever. I'm going to go out and put on some new positions. And exactly what I did. Right on the close, right when the market was at the lowest, the premium was just surging. I put on new positions and took my buying power close to 90%. Now remember, John, previous 4 years, I mean, I'm profiting really well. I haven't had it. I mean, I'd spend less than 2 minutes a day looking at the account, putting on positions a couple times a week. No big deal. Been tracking all this. I'm a stats teacher. I'm all excited and motivated. I'm like, here's a great opportunity. And then, John, next slide. This is what happens when size, you just don't control your size. All 4 years of my profits. Now, remember, I woke up, I think it was Sunday night, futures opened at 6 o'clock, and I look at my account and I thought maybe a computer screen had broke or something. My account off 4 years of profits were gone. And I'm watching the account bounce around 30, 40, $50,000 at a tick in the spreads wide. And I've got to make a decision. Is this the crash? Is this like going to be Black Monday? Is this the crash? I called a buddy of mine and we're talking about it. And he said, well, I'm just going to hang in there. I said, well, I want to live to trade another day. So I'm going to close these out. This is on Sunday. Now, on Sunday, the futures markets, they trade. It's not as liquid. So the spreads are pretty wide. And I can remember the spreads are like $5,000 to $10,000 a spread trying to close these trades and close them. It's just bouncing all over. And I did. It took me about an hour because I had so many positions on, John. I had to click and click and click and click and click, and it's bouncing all over the place. So that was one of the bad things I thought about my style, having too many little positions on it instead of fewer larger positions. But finally got them all closed, and there I was, back to $50,000, just like I was in 2020, like nothing had happened.
How did that feel?
It was a huge adrenaline running through you. Everything's emotional. I got to believe that, it took probably the rest of the night. I mean, I was up at like 6 or 5 in the morning. I can just remember the complete adrenaline flow going through my head. The next day was sad. It was like the markets flying all over the place the next day. And I was sad that all of that money had gone away and I couldn't trade. And so I said, I'm going to take some time to think about this. And you're sitting there day after day after day. And 1 week later, had I not done anything, all of those profits would still be there plus some. So the strategy, the strategy was fine. The market It was in the maximum profit zone of the strategy, but you couldn't stay in it because the buying power was exceeded. I think at one point I was at like 200% buying power, closing positions, trying to keep my buying power down. Finally, I just had to close everything out.
How did you tell your family about this? It's a lot of money.
Well, being family, I am the family. A single guy, never married. So it was, it's money that it was my cash account. So it's money that I could play with. Doesn't change my lifestyle at all. I have other accounts that I do different investments with. It's just not easy losing. For 4 years, I never had a losing trade, not one trade. And this was just I was forced to lose in this. And that's what I didn't like. I put myself in a position that forced me to have to be a loser. And so hence now I still trade, but I trade knowing that risk factor is going to happen again. In fact, I kind of look back over time. The VIX that day, that Monday, spiked to 65 or something like that. I mean, it's just massive, but it does happen. It happens about every 5 to 7 years. You get some anomaly that happens and bam, the VIX is there. So you have to be ready for that. And I made a few changes to the strategy. And I'm sure when you have your losses, you look back and you go, what is it that I can do differently to make it better and not have this happen again?
You and I are active in the same Facebook group, Tasty Trade Options, and you have been posting regularly about your trading there. I think most traders, when they experience loss, they will just kind of disappear from the group. You don't hear anything more from them, but you actually posted and shared what had happened and told in detail to everyone. Why did you decide to be so open about such a huge loss?
It probably just comes from my teaching background, and I always told my students, when you learn from your mistakes, that's the best lesson you'll ever learn in life. And, I have a group of traders that I trade with and guys that I talk to, and we all talked about it. I mean, I wasn't the only one in the group in that same boat. Some guys stayed in it and they did fine. They didn't end up losing any money. And other guys closed it out like I did and started all over like I did. But we said, what can we do differently? What is it that could make this strategy successful, but yet able to take on that type of a risk event going forward?
The main change you have done, as I understand it, is that you are now diversifying with the underlyings.
Yeah, John, I think that was one of the key things. I was just trading the ES because it was easy. You open up your account, you have ES, you don't have to flip screens around. It was just convenient. Okay. So what I do now is I trade like gold and bonds and oil, natural gas, corn, whatever it is. I still trade the same strategy. I actually trade the 111. I'll tell you about that in a second. But I trade the 112 and in those different asset classes that are uncorrelated. Because if something happens in corn, it's probably not going to happen in oil. So that takes the risk. I mean, I could have, had I been in that situation, I could have closed the other positions for profits and opened up the buying power that could have kept me in those positions for that week and not end up losing any money. So the uncorrelated risk is huge. And when I mean uncorrelated, I don't mean diversified. People get those two words, I think, messed up. People will buy Microsoft and then they'll buy GE and say, oh, they're diversified, but they're not. When the market goes down, they both go down. Where corn and oil and bonds and the ES, they're just not related to each other. They're so much more uncorrelated, and that keeps your risk in check.
Have you made any other changes to your trading style and how you do it after this experience?
Well, yeah, the experience definitely was a learning lesson. And what we learned is not only do we want to be uncorrelated, but we want to be able to take advantage of some things. So here's the changes that I've made to the 112. I enter the trades now as a 111. And the 111 is going to make as much money as the 112. The trap isn't as large. But when I have a nice volatility spike or a nice market pullback like we have this year, I will take that 1 far out of the money put, and I'll buy it back and sell 2 further out of the money puts for a little bit of a credit. So I changed a 111 to a 112, and I don't have that big loss. Had I started with a 112, there'd be that immediate vega loss like you just showed us in the previous graph. But with the 111, that vega loss is just very minimal, and now I'm taking advantage of a high volatile situation. So that's the first change I made. Well, the first change was actually doing uncorrelated assets. But then I enter them as 111s, and then I do 3 time periods. From 0 to 45 days, I do a 50 wide put debit spread. From 45 to 90, I do a 100 wide put debit spread. And from 90 to 135, I do a 150 wide put debit spread. That gives you a little more delta hedge on the way down, number one. Number two, as time or theta decays out of that position, if let's say I put on a 135 day and it moves into, let's say, down to 85 days, I'll take that put debit spread from a 150 and narrow it to a 100, and I'll receive a credit for that because I'll be buying back one, selling one closer at the money. I get a credit for that. So I'll bring in another $200-300. Then as it decays into the 45-day range, I'll narrow that from 100 down to 50. I'll take in another credit, another $200-300 on top of that. So I might start with a $10 credit and end up with a $15, $16, $18 credit by the time the trade has decayed through its time frame. So I like this. The uncorrelated part, risk diversifies. The time, the wide put debit spread, much nicer delta hedge. I mean, I can have volatile days of 2 to 3% moving down, and because I have 150 wide, shows me a profit for the day. I like that. And then I can change it from a 111 to a 112 and take advantage of some of that extra premium. But I do run my buying power at 50% still. And I feel confident because I'm uncorrelated. It's not really 50%. I mean, my ES might go up a little, corn might go up a little. It hovers around 50% even when they have volatility spikes in the market. So I like that. So I feel, like you said, why did I go back to this strategy? Fits my lifestyle. 2-3 minutes a day. Now I feel very risk adverse in this position, up 21% year to date this year. I feel good about it. I like it.
But your new style must take a lot more management, I would guess, than before.
It does take a while to click through the different strategies, but I mean, the different asset classes, gold, but once you get familiar with them, like anything, it's just second nature. You almost know what strikes you're going to buy and sell, and it goes pretty fast. Maximum 5 minutes a day, and usually it's in the morning, in the first 9:30, 9:45, something like that. And all I do is look at it. I really don't do anything to it. I just kind of look at it and see how the volatility is for the day, or if I've got enough money to put on a new position, that situation.
We're going to talk about your results in just a second. But first, I always ask my guests to place their strategies on let's say, a risk scale from 1 being very low risk and 10 being very high risk. So now I'm curious, where would you put the 112 strategy?
John, that's a tough question. And I can't answer it with a number because I think it depends on your understanding of the Greeks and understanding of the options and understanding the background of the market. I mean, you could teach a beginner how to put the strategy on, and they would say it's low risk, like I would say, and they would make money like I did for 4 years. And then they could have one bad day, and then they'd say, oh, it's high risk. So it's just hard to quantify that strategy as at a risk level.
But considering your huge loss last year, certainly cannot be 1 or 2.
Yeah, but prior to the loss, I would have said 1 or 2, right? So, like when you had your big loss, now all of a sudden, is it a 10? I mean, I don't know. I honestly think it's a very low risk, low management strategy with the potential. I mean, if you manage it by be uncorrelated and you keep your buying power and your size managed, I think it's extremely low risk. You just have to manage the size of your account. You can't get aggressive like I did.
Mm. No, and I think that's a very good point. And you were referring to my big loss, which was when the pandemic hit, and I actually lost half my account, and I was trading iron condors, but just taking on too much risk, having too many of them on, and then kept believing it had to turn around, and it didn't turn around, and suddenly half my account was gone.
Yes, yep, we've all been there. If you haven't experienced it, you will experience it.
True. So let's get to your results. You already showed us how your strategy was developing before your big loss last August. And then you have continued to trade 112 and 111 with the changes that you have explained to us. So, what have been your results after August last year when you were back to 50,000 in your account?
Well, let's just say when I started in 2020, my goal was 1 to 2% a month. You're just kind of feeling out the strategy. But in reality, the results were 3 to 5% a month. And you get real excited about it. And then you don't have a losing trade for 3.5, 4 years. You just get all pumped up. Well, yeah, since the loss, and diversifying. Of course, when you go uncorrelated, some of those assets work for and against you just slower. Things are just like gold is a different animal. Bonds are a different animal than the ES. Their volatility is a little bit different. So my new goal is anywhere from 2 to 4% a month. That's my personal goal. When the market went down pretty heavy this year, I'm at 21% year to date. So that's, annualized might be 40 to 50% a year. But if I could I'd be happy with 20 to 25%, 2 to 3% a month. But even being uncorrelated like this, it's been pretty decent. I'm not complaining. So let's just say my personal goal is let's shoot for 3% a month and keep those assets uncorrelated and keep my size in check, keep my buying power at 50% or lower. I feel pretty good about it.
And you have been growing your account after the big loss last year. 21% this year and also some last fall.
Yeah, basically starting all over again, starting with around 50,000 my cash account. I have other investment accounts that I trade differently, but in this particular strategy, that cash account, yes, back to 50,000 like I was in 2020.
How do you measure your results?
Well, being a stats teacher, I've got a pretty complex spreadsheet set up that kind of shows a lot of different things, but essentially, the day-to-day variations flux depending on the volatility, the vega aspect of the trade. Theta eventually comes out of it through time. So I record everything daily. I chart everything weekly, chart everything monthly, chart everything yearly. Daily is just kind of fun to watch as it just bounces around. But weekly's pretty consistent, as you saw the other one, and the monthly chart that we talked about earlier, you could see it's pretty. I mean, from trading the markets, John, things depend on in the options world, depend on the volatility that's going on, more so than the theta. The theta eventually comes out, but volatility rules in this game, and that's what we got to be careful on.
So we have been through a lot. How would you sum up? I'm in particular thinking about what are the pros and cons of this strategy as you see it?
The pros of the strategy is it fits my lifestyle. When you're trading iron condors or stuff, you got to keep your eyes on what's going on in there. Where the 111 or 112 strategy, it's pretty much put it on and just watch it. So I like that. The biggest pro to me is it just fits my personal lifestyle. Very little time management needed. The con of the strategy, well, the only con is the vega risk. If we have a nuclear war, we have a meltdown, and volatility spikes up to 60, I mean, it's going to be interesting. But being uncorrelated, You know, if 50% of my buying power is split up into 5 assets, that's only 10% of the account being in the ES, and that explodes to 60, it's going to be manageable. My buying power might go to 65 or 70, but I don't see it going through the roof with those assets. So again, the pros, easy strategy, very little time, put it on, watch it, very little management. The cons, the vega risk. It's all about the volatility.
Let's say I want to start with this strategy. What would be your most important 1 or 2 tips you would give me?
Uncorrelate your assets. You know, keep your size in check. Keep your buying power in check. If you're uncorrelated and you keep your buying power in check and keep the size of your contracts down, you've taken care of all of your risk. And that's the most important thing.
What would be good resources to learn more about this?
The guy that probably does the most with this is Tom King, and he's got a series of videos out there on the 112, and he gives you pretty much a daily update on his 112 strategy. He's a great correspondence person. If you watch the Tom King videos, I think that would be the most helpful and probably your best resource at this point.
Would you have 1 or 2 books about options trading that you would recommend to other traders?
No, you know, I always say it's hands-on that teaches you the lessons. And so I think, you know, like I got involved by going to an options seminar to just learn about the options and those things out there. But with the internet now, there's just so much information available on the internet. You have to, you know, people say, oh, read this book and do it. I think you just got to try. You got to have skin in the game. When there's no skin in the game, there's no fear. There's no blood rush. You got to have the skin. Who cares if you lose some money? You're learning every time you lose.
And I would also like to end with recommending you to watch some of the other interviews we have done on this channel about a lot of different strategies and topics related to options trading. Murray, thank you very much for sharing your experiences with the 112 strategy.
Well, John, I appreciate you reaching out. Hopefully we'll do it again sometime.